Hello everybody and welcome to the basic course where we will be explaining and going over exactly what Forex is. So let's begin now. What is Forex and what is the Forex exchange market? So the Forex exchange market, also known as the FX or the Forex market, is a global marketplace for exchanging national currencies. And because of the worldwide reach of trade, commerce and finance, the Forex market tend to be the largest and most liquid asset markets in the world, right? And over $6.6 trillion is exchanged in this market every single day. Now, in the Forex market, currencies trade against each other as exchange rate pairs, right? Remember this, exchange rate pairs or just rate pairs. For example, the euro versus the euro versus the US dollar, right? Euro USD, as is more commonly known as, or EU, right, is a currency pair for trading the euro against the US dollar, right? And Forex markets exist as spot or otherwise known as cash markets, as well as derivative markets offering forwards, futures, options, and currency swaps. And the Forex markets are opened from Monday to Friday, 24 hours a day, right? So the market is always open from Monday to Friday, except for on the weekends, right? Just a small side note with currency pairs. So the base in this example, right, Euro USD, the base pair is the euro versus the US dollar, right? So just keep those those keywords in mind and keep these key bullet points in mind as well, right? So if that was a bit confusing, I'm just going to explain exactly what the Forex market is in a real life example. So let's say you are from London, right, and you've got £100, in cash or in a bank, and you're traveling to New York City, for example, right? And now you're in New York City, you want to exchange your £100 to to dollars, right? And you're gonna do this at the exchange shop, right? And when you exchange it, you get $136, for example, right? And now let's say you don't spend this money, and when you go back to London, this money is now worth £105, right? So you now have £105. So you have, your money has increased from £100 to £105, and you may be wondering why this happens, right? And it's because the exchange rate between the GBP, the Great British Pound Sterling, right, and the New York dollar as well, otherwise known as the US dollar, right? The exchange rate is always changing, right? The exchange rate can increase or it can decrease, right? And this is measured and changed every single day, right? And so if you went on holiday, right, and your £100 over like the span of a week became £105, is because the exchange rate has, for example, increased, right? And either one of these currencies has become stronger or weaker, causing your £100 to become £105, right? So that's just a real life example of what Forex is. And now let's move on to what is a pip. And a pip is a measurement of the price change, changing in a currency pair, right? It's the measurement of the price change in a currency pair trading on the Forex market, right? And a pip is 1/100th of 1%, or the fourth decimal place, right? So 0.0001. So in an example, this would be 1 point. So let's just say the exchange rate for Euro USD is 1.1251, right? And this will move. Let's say it moves to 1.1241. The exchange rate has moved by minus 10 pips, right? Or it has moved down by 10 pips, because we started off with 1.1251 and now we're at 1.1241, right? So we have moved down by 10 pips. Now, pips can be measured using the ruler tool in TradingView. So let me just show you what that looks like, right? So if you just go on TradingView and you click on this ruler tool, it would look like this, right? And that is 100 pips. So this last number over here, this would be 100 pips, right? And now, let me quickly go back into this. What is a stop loss and what is a take profit? A stop loss is a price at which your trade will be automatically closed in loss. And an example would be if your stop loss is placed at 1.1000 and price reaches to this point, or the exchange rate, the price of the exchange rate reaches to this point, your trade will be automatically closed at negative or a loss. And this, the exact same for take profit, except the opposite. The take profit is a price at which your trade will be automatically closed if in profit, right? Or in profit. For example, if your take profit is placed at 1.1250 and the price reaches it, if price reaches your trade, your take profit, your trade will be closed instantly at profit, right? And if I just show you this on the charts, so let me just quickly change this to green so it looks cleaner. Okay, so let's just say you entered a trade over here, right? So I'll just represent this as our trade. So my stop loss is at the price 0.87950, right? So if price happens to reach that, this area, I will be automatically closed in, let's check how much pips it is, right? Using the ruler tool, we will be closed in 20 pips loss, right? And for the take profit, my take profit is at 0.88729. So if price happens to reach this area, right? Price reaches this area, we would have made in profit 60 pips, right? Almost 60 pips. So that's how take profits and stop losses work. So if we just see what happens in the trade, we hit take profit, so our trade was automatically closed at this very point, right? As soon as that candle hit our take profit, or price reached our take profit, our trade was also automatically taken out, right? And so yeah, that's how stop losses and take profits work. Let me just show you an example of a stop loss. So let's just say okay, so let's just say I decided to buy over here. I bought worth of some of this asset, right? And we play price. So I hit stop loss. So what does that mean? Price reached my stop loss, which was 0.87411, and I was automatically closed out of my trade with a loss of 20 pips, right? And that's all stop losses and take profits are. And that's it for the basic course, and I'll see you guys in the next one.